Today, the RLS boys share 7 frequently asked questions clients have posed. Stay tuned as we give our answers right now on the Retirement Lifestyle Show.
Retirement Lifestyle Show is back. My name's Adrian Nicholson, and I'm joined with my co-hosts Roshan Loungani and Erik Olson. We have another exciting episode for you all today, so we're just going to get right into it. The topic we're going to discuss today are frequently asked questions, and we're going to be tackling this topic today because hopefully our listeners and viewers have some questions on their minds or some concerns that we might have been talking about with our clients, and we're just going to share some frequently asked questions we've been receiving, and hopefully there might be some overlap with some things that have been going on with your situation as well. And if there aren't, we're always happy just to have a discussion with you. Our information is in the show notes. So we're just going to kick it off today and go right into it, Roshan. What's something that you've been asked frequently or something that's you've seen on the internet recently, or what are some things people are looking at today that they just have questions that need to be answered?
Well, one item I've been asked about really throughout the year, and I've got some more questions as recently as last week, is about I bonds. And I think this is a great thing people are looking at right now because with inflation being as high as it is, that is a good place for you to look to try to uh, do well with some of your cash. So I bonds right now are paying an annualized rate of 9.62%. If you're interested or want to look into them further, if you go to the website treasurydirect.gov, where you can buy I bonds. We've also covered them before. I think at least twice in our previous episodes, we've talked about I bonds. So I bonds are government bonds. They're Series I savings bonds that you can get that have a rate that is adjusted for inflation. So with what's been going on this year, inflation being the hottest and most important financial topic right now in the United States throughout this year, that is driving everything with Fed action. I think that is very astute for those that are thinking this is a place to look at for opportunities.
So, Roshan,
Yeah, I
people
agree.
sometimes,
Inflation's the talk of the town, so people are trying to beat it. But yeah, I definitely like how we started that off. What do you think, Erik?
yeah, I was just asking in terms of people are asking about this, Roshan, and saying, how much can I invest? What do you tell them?
Yeah, so the cap right now is you can do 10,000 per person per year. There's also a little bit of you can put a little bit more in there if you are getting a tax return, you can direct that to go directly into I bonds, but it is per person. So I do have clients where they're a couple with the young kid, and they went and got 3 of these I bonds, two in the parent's name, one in the kid's name. So there are ways to get a little bit more in there, but the cap is $10,000.
And I've got a couple pieces of good news there too. It's you can have a natural person such as you, but you can also have your trust, your living trust can be a buyer that has an eligibility for another 10 grand. If you have an LLC, that also can be a buyer. And so let's say if you have a his and hers trust and there's you're a married couple and you have an LLC, there's $50,000 you could put in each year toward that, not including your tax return refund. So now what
Yeah,
happens if you say, I want out?
so you've got to stay in there at least a year. If you cash it in before 5 years, you'll lose 3 months of interest. But if you hold it for longer than 5 years, you can take your money out, keep all your interest, and you're all set. And they'll earn interest for up to 30 years. So you've got a while. Well, you've got a while to make that decision, so to speak, as far as pulling out goes. But it's definitely worth noting that you I would say look at this ideally for at least 5 years, and you really can't look at it for less than 1 year because you don't have an option.
Mm-hmm. So it wouldn't be necessarily emergency fund money, but it might be, let's say you're planning on doing some big home improvement project or purchasing a car 3 years, 5 years out. You could say maybe if it's we're not, there's no guarantee it's going to stay at 9.62%, but if it were to stay up at, let's say, the 8% level or the 6% level, you give up a quarter's worth or 3 months worth of interest. You've only given up a 1.5% to 2%. So you still, in those two examples at 8%, you still kept 6 that year. Or if it was at 6, you still kept 4.5 that year. So it's not like the worst thing that's ever happened.
Well, and even if it goes down to, yeah, after, just thinking about what the Fed's policy is and their plans of getting inflation under control and so on, they're putting 2024 as the target. Even if you get 2 years with these, or even a year and a half, because the rate does adjust every 6 months. It's every October and why can't I think of the month that's 6 months before? It's at April and October. It adjusts every year. So even if you go through just a year and a half or a year of these almost 10% rates of return, if the rates come way down, you still are going to look at probably a good 4 to 5% average over a 5-year time frame.
Good stuff.
Awesome. Yeah. Thanks for starting us off with that one, Roshan. That's a really big one. It's can lead me into one of the frequently asked questions I've been getting, what to do with my excess cash flow. And Roshan just presented that's an opportunity as well. You might want to consider looking at I bonds if inflation's just something that you're extremely worried about right now and you're trying to figure out a way to get some type of return. But this is a really good question. It can be a little complex too because it just boils down to what your situation is, what your cash flow is looking like, how much are you able to save. So there's really a lot to go into this. So this is where it'd be beneficial just to really have a conversation just to see where you're at right now. But I could just give a few points to this one where a good one, and Erik mentioned this before, is just build up that emergency fund, that cash reserve that you have. That's a good place for you to really start if you have some extra money coming into the door, whether this can help you out if an emergency comes up or just potential investment opportunities as well. There's a lot of things you can really do here with your excess cash flow. So building up emergency fund is definitely a top priority as well. And then where you're looking to deploy extra funds once you have that build up, you can look at the 3 different buckets that are out there when it comes to investing, saving for retirement, or any short-term or long-term goals. So those 3 buckets are tax advantaged, tax deferred, and taxable. And all 3 are just creative ways that you can save to, one, either reduce your income or save for retirement. There's a lot of flexibility built in here. Do you guys want to touch on anything before I go deeper into these 3 buckets?
No, I'm eager to hear what you have to say.
Okay, awesome. So again, if you have some leftover cash flow and you've built up that cash reserve that you have for those emergency funds, we look at 3 different buckets that you can invest in. And again, it's going to be different depending on what your situation is. So let's just say you're somebody that has to pay a lot in taxes every year and you're just trying to reduce that tax bill as much as you can and save. You might want to look at this tax deferred bucket that I mentioned. For example, this can be an IRA or a 401k where you can contribute to this account and lower your taxable income for this year. So that might be a good strategy for you to use. And also, if you have 401k, your employer may offer you a match. So that's free money that you want to contribute. So your employer can help contribute and match that as well. If you're somebody that's looking out way towards retirement and you really want to save a lot of money and do it in the most tax efficient way possible, if you feel like you're going to be in a high tax bracket in retirement, you might want to look at a tax advantage bucket. For example, this could be a Roth IRA where you contribute to this account after tax, but the growth on it is tax free. So when you start withdrawing from it in retirement, you don't have to pay taxes on it. So again, if you're somebody that's worried that you might be in a higher tax bracket when you're forced to, let's say, for example, start withdrawing money from your 401k and your IRA for requirement minimum distributions, having a Roth IRA to pull from might be very beneficial for you. Then the last bucket is a taxable account, and this is the more flexible account. This is one where you can create maybe an automatic savings where you have more flexibility to pull from this account. You have a short-term or maybe a mid-term goal that you have to get to. This one doesn't really provide too many tax benefits, but it's a way for you to invest in a whole bunch of different investment options so you can have your money work for you and grow. So those are some potential ideas I have for those people that say, hey, I might have some extra money coming through the door. What should I do with it?
Yeah, and with what's been going on in this market, if you've got a long-term time horizon, and a classic move, so to speak, would be dollar cost averaging. Adrian, with your topic of excess cash flow, if you got extra money every month, if you're continuing to buy as the market's going down, you're accumulating more shares, and then when things eventually recover, you'll have more of those gains because you were buying more shares on the way down.
Yeah, and I just want to touch back again on that automatic saving piece, which is really key when it comes to cash flow. And you might not know where to start or what certain dollar amount to use, but just having that automatic savings built in can really highlight the number for you. Where let's just say you started your automatic savings and you feel like every month you feel a little bit tighter and that might be too much high of a number, then you can just notch it down till you get a level that you're comfortable with, where that money's kind of out of sight, out of mind, and starting to work for you in the investing world.
Yeah, well, I think that's good. I'm going to say a word also about just one other category. You talked about the various tax treatments of it. I will also say one area, if you have any sort of debt other than your mortgage, certainly, if you have any other sort of debt, if you've got free cash flow, I would just be encouraging you to put that money to work to reduce that debt.
And Erik, let me just ask you about this just to make
Mhm.
sure. You're talking consumer debt, right? You
Yes,
had said besides your mortgage, right?
right. And in some cases,
What are your
maybe
thoughts on car notes as well? Would you put extra money towards paying those off?
Yes, I recognize that car notes, generally speaking, recently have had lower interest rates than the
Mhm.
prevailing inflation rate. So, at just a purely mathematical level, you may say, "Well, that's foolish because the inflation effectively is paying all of my, it's paying my interest rate and then some. I'm actually coming out ahead by virtue of the fact that I have a higher inflation rate than an interest rate." Well, that would be true if the cash that you then are not deploying into that debt is somehow being deployed at a level comparable to the prevailing inflation rate. That would be true. But if your cash is just sitting there anyway, and it's really not doing much for you, and this is a way, at least it'll wipe out that interest cost. And on top of that, I do think that because life sometimes deals us an unexpected twist, to the less that you have in terms of a carrying load on as a burden on your ongoing cash flow is a healthy thing. It's a useful thing and it's a freeing thing. So it's at one level it's a psychological question, at another level it's a mathematical question, at another level it's a preparing for the unexpected question. But I would say, yeah, if you've got consumer debt, certainly other than a mortgage, I would work on whittling that down if you have that spare cash.
Mhm. Yeah, you got to be strategic too. How I mentioned before I addressed that topic was it's going to be different for everybody, and how you deploy that extra cash flow as efficient as possible is really going to help you out and can make your situation a lot better, other than just kind of just finding whatever you can, just whatever works for somebody else. Just going with that strategy might not fit yours. So I definitely agree with all the points you guys
Mhm.
are sharing. Yeah.
All right,
Excellent.
what's
And
next?
Erik, I was going to pass it on to you to give us the next one.
Yeah, so lately I've been getting some questions from clients actually about structured notes. And it's partly been because they've had other experiences with them or they've heard about them and they're saying, would this be a good time for this? In other clients' cases, they're saying, I've never heard of it. So what I thought I'd do is have a little conversation with you today and talk with you about what is a structured note and why might it be a useful thing to include as part of your overall portfolio. So let's just begin with the sort of the surrounding problem. there's no question that in the recent weeks and months, all of us have been watching the markets, not just stock markets, but also bond markets, just really having a hard time of things, sinking, sinking, sinking. In fact, we've talked, I think, about how the first 6 months of 2022 were the worst 6-month start to a calendar year in the S&P since 1970, in the Dow Jones Industrial Average since 1962, in the NASDAQ ever, the Russell 2000 ever, the Barclays Aggregate Bond Index ever. So with that sort of an environment, might it be possible to find something that has the potential to go up but not down? And the answer is that depending on the structured note that you might find, a structured note actually might be a candidate for that sort of a solution. So what is it? First of all, it's a security issued by typically a bank or large financial institution, which says we're going to stand behind the promises made in this particular structure. But underneath the hood, what we're going to do is to put together a bond or some bonds and some options to provide you with a very quote unquote structured set of possible outcomes. I'm going to give you an example of one such structured outcome that some of my clients put into action on August 5th. This isn't available now, so I don't have any concerns about you thinking I'm trying to sell you this. I'm just using a real world example to describe one such instance of this. So that on August 5th, what happened is that those that made this investment had only 4 possible outcomes. The first outcome would be that at some point before the end of the ride, the issuer, in this case, a large multinational financial institution, would go out of business or would have some such difficulty financially that they couldn't make good on the promise. And that's a possibility. I don't want to exclude it, but that's a remote possibility. And barring that happening, there are only 3 other possibilities. So possibility number 1 is that as of the first anniversary of that investment, August 5th of 2023, in this case, if the S&P 500 was up by even one fraction of a percentage point, then the investor would receive their investment back and a 10.45% interest payment. Period. Done. Next. But what happens?
So if it's up anything, just got to be positive.
As long as it's positive, it could be up 100%, and you'd only get 10.45%. It's very predetermined at that moment what you would have received. But if on August 5th of 2023, the S&P 500 on a price level only, forget about total returns, on a price level only, were lower than it had been on August 5th of 2022, then buckle up. You're in for a 4.5-year ride from that point forward for a total of 5.5 years. And you just wait and wait and wait. At the 4.5-year mark after that date, or 5.5 years from when you started, now there's only 2 possibilities left. One is that the S&P 500 is down. If the S&P 500 is down by any amount or down by 50%, it doesn't matter, the investor would receive his or her money back. On the other hand, if the S&P 500 is up by any amount, then in this case, unlike at the first anniversary, it's not a fixed percentage payment. It is just that by whatever amount the S&P 500 is up, that is the amount that you receive in addition to receiving your capital back. Now, there's lots of other examples that one could cite, but this is an example of one design whose attribute that some of my clients found attractive at that point was, okay, you're telling me that I can put some money into the market, and barring the collapse of this major financial institution, I will receive my money back as sort of a worst case. And there's a possibility that I would have 100% upside if it goes 5.5 years on whatever the S&P 500 does. Okay, I think that sounds interesting. I'll do that. So here's an example of ways in which these creative use of these underlying tools that I mentioned, bonds and options, can produce an outcome for you that allows you to take a step that you might not otherwise want to take. For example, if I'd said, hey, do you just want to put some money in the S&P 500? I think 5.5 years from now it'll be up. You might say, well, that might be true, but what if it's not? And then in that case, that might cause you to pause to take that step. But anyway, there's I'm using this metaphorically, millions of designs, as many as the mind can conceive. But this at least is one where when people are thinking, I just can't stomach any further downturn, this might be a solution. There's a possible solution.
Yeah, especially in you started that out with the numbers, essentially every public market being down this year. That's where I think the opportunity is there. The other thing with the structured note that I think is very important, you said, is that it's whatever the mind can conceive. They can build these things for you, and there are new ones every month, new opportunities every month that the various investment firms put out there. That's
interesting. And what are like the cost dynamics to it? Since there's so many out there, do you have to kind of shop around for the costs, and just is that one aspect of it too?
Well, in terms of the minimum investment amount or the underlying expenses of it?
Oh yeah, I guess
Okay,
both.
well, the minimum investment amount will vary by the sort of design, but typically these are issued with with some sort of prefabricated version to it, and there's just such a large appetite in some places for these sorts of things that you can do this for $1,000 or $2,000 as little as that. As far as the underlying costs are concerned, yes, there are indeed costs, and those have to do with the options contracts and with the bonds, and the people who assemble these structured notes, of course, are not doing it as a charitable activity. They're making a profit on it. But those outcomes that I told you already reflect the inbuilt costs. So, for example, if you said, hey, well, what if they could do it in an entirely costless way? Maybe then at the 1 year anniversary, rather than you getting 10.45, you got 12 or something of that nature. But the defined outcome itself, as defined in the way that I just explained it, is not then further reduced by underlying expenses.
Awesome.
Sure.
Thanks for sharing that, Erik.
excellent, guys. What other questions? What other questions are you guys getting, or should I jump in?
Yeah, go ahead, jump in.
Well, so one of them that I've gotten is just in light of what the market's doing, people are asking, well, am I okay? Right? Am I okay financially with what's happened? And that goes back to what we frequently mention on our show is revisiting your financial plan. So we do that as a standard typically with our clients. We update data and review what's been going on through our meetings, and that's been a source of comfort for most people, where they look at it and they say either okay, I am okay, is the response, or it's not as bad as I thought. I've got yeah, I can make minor adjustments now that will make me okay in the future. So I think there's a lot of value in that, keeping your eyes on the prize, so to speak, looking at your plan and seeing um, how have these markets impacted me, and it, when I've having had these conversations, as I said, it's definitely been a place where people have found comfort. I've not had many conversations where people were, way ahead of schedule or on track for their goals, and now the market decline has caused them to need to shift their lifestyle completely.
Mm-hmm.
Yeah, that is a common one I've been getting as well. And like you said, the plan aspect provides like a lot of comfort and just helps with just moving forward, not making any like changes or making minor adjustments if you need to. But again, that plan really can show what it's like moving forward and really just puts a lot of stuff in perspective what's going on right now, because again, there's just a lot of volatility in the markets right now. There's a lot of like macro and economic data coming out, and just a lot of stuff going on right now where you really need to focus in on your plan and let that be the driving factor.
Mm-hmm. Yeah. Next topic then. Or do you want to keep exploring that a little further?
No, go ahead. Adrian, do you want to go with yours next?
Yeah, so another common one that I've been getting recently are what are the main differences between exchange traded funds and mutual funds? So I have four key points to this one that are things that people should really consider and look at that really show the difference between these two different investments because they tend to have some overlap and some things that make them different. So, one of the main features that's different between an exchange traded fund and a mutual fund is how the asset is managed. Typically, exchange traded funds are usually passive investments that invest in a basket or a pool of assets that gives an investor an exposure and more diversification across all these investments. Compared to a mutual fund, this is sometimes usually an active managed fund where it's similar, where it invests you across a bunch of different investments, but is sometimes buying and selling within the fund. So that's one big difference on how they are managed. Is there anything else that you guys want to put in on this piece on how exchange trade funds and mutual funds are managed?
Yeah, the big one that stands out for me is the term exchange traded funds means it's traded on the exchange. You can buy and sell intraday. So at any time during while the market's open, you can buy and sell these things. Where mutual funds, you're buying from the issuer. So if you buy a Vanguard or a Fidelity mutual fund, you're buying it from them. And you can typically only do that at the close of business, buy or sell every day. So I think that's another big difference between the two.
Yeah, that was my other point. But what you brought up too is the cost aspect too, that differentiates between an exchange traded fund and a mutual fund. Whereas we mentioned exchange traded funds, you can buy and sell them throughout market hours. So this can sometimes lead to a commission that you have to consider when it comes to exchange traded funds. Whereas mutual funds, the cost can vary depending on the type of share class you have because mutual funds tend to have different shares that you can invest in. But some of the common things that investors need to consider where mutual funds have transaction fees, distribution charges, and operational costs that you have to look into as well. Is there anything that you guys want to touch on with the cost aspect as well?
Well, I'll just comment. I want to come back to your previous comment about passive versus active. I believe it is absolutely fair to say, as you did say, that ETFs, exchange traded funds, have much more historically, at least, been the passive instrument of choice once they became firmly established as a regular and widely understood tool. And mutual funds, sort of recognizing that edge that they had on the passive side, I think started to gravitate more toward somewhat more active strategies. Another reason for that, incidentally, is that exchange traded funds are essentially that what they own is fully transparent, whereas in a mutual fund they don't have to report that except every 90 days. So it can give the mutual fund manager who doesn't want to give away the secret sauce the ability to disguise a little bit is going on underneath the hood, whereas with an exchange traded fund that's not as easily possible. But having said that, after it became clear to some of the smaller entrants into the exchange traded fund market that the passive strategy landscape was already dominated by some of the super large exchange traded fund houses, like I don't think I need to name them. But at this point, they said, okay, well, our way into this market then is to differentiate ourselves. And the way to differentiate ourselves is to go bring some more active strategies. So as a result, you've now started to see this emergence of I'll call them three types. One is the purely passive market capitalization based approach that is the way that we normally think about an index fund. The next at the other extreme is an active managed approach, but it's transparently active. And then the intermediate version is it's a rule-based active approach as opposed to a subjectively based active approach, meaning they say this is how we select the components of this or the investments within the exchange traded fund. You'll know in advance how it works, and if you want that sort of that active algorithm as opposed to an active stock picking sort of approach, an active algorithm in your portfolio, here's a way that you can access that 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 maybe quantitative approach with a very low cost relative to the other sources that you might obtain it and what you pay for them. So on that basis, Adrian, you just saw me transition from active passive into the cost area. I am agreeing with you that there is oftentimes a cost advantage on the ETF side. How'd you like that as a
But that being
transition?
that being said, though, guys, there are very expensive ETFs out
Oh,
there as
yes,
well,
that's true.
right? So
Mhm.
the landscape has changed to where I think there was a time period in the late 90s into 2000s, 2010s where you could in general say ETFs came in as a low cost
hmm
provider to take market
hmm
share. Whereas now you can have pretty much a low cost passive entrance is probably what ETF started
hmm
as. And now you can say, well, all those general rules are out the door. You can get active management there. You can get high cost, low cost. They're really just an alternative or a competitor to mutual funds. And you've got to look into each ETF further because those general rules definitely don't
hmm
apply like they
hmm
used to.
Mhm. Yeah, and especially now, which leads me to my last point, the tax consideration as well. It's just going to be varied. Where if we're going to take, let's just say, a passively managed ETF, there are going to be fewer transaction costs, which will help avoid taxes compared to a mutual fund where, let's just say, there's a lot of buying and selling can lead to more capital gain taxes for the investor.
Well, yes, it is. That is absolutely the case. It's interesting. The exchange traded fund lobby won some provisions when they were first establishing these designs. And by the way, there are different designs. We refer to them as exchange traded funds as if they're all of one kind. But the truth is that some of them have patents on the way in which that they manage the assets underneath, and so in some cases they enjoy even further advantages from a tax standpoint. But the interesting design feature that ETFs generally share is the ability, instead of needing to sell positions, they can sometimes swap positions. And as a result, they delay the realization of those gains, or for that matter, simultaneously the losses. Though I don't see any reason that they'd want to not realize some losses as a long-term strategy. But here's the other thing: it's not merely the behavior of the fund manager internal to the fund. It's the behavior of the owners of that investment. So other investors out there, when another investor sells a mutual fund that has and says, I want my money back, what happens? Well, the mutual fund manager has to then sell some positions to generate the cash necessary to pay that investor out. You, meanwhile, are still an investor in the fund. You're a shareholder. And as a result, at the fund level, it realized those gains. And so at the end of the year, if you are still a shareholder of that fund, then you, like all other shareholders on a proportionate basis, are awarded, quote unquote, and I'm using that totally ironically and facetiously, you're awarded the benefit of that other person having triggered that gain that otherwise wouldn't have been triggered, and you get a distribution of some either short-term or long-term capital gains that you must then pay taxes on. This is all assuming, incidentally, this is in a taxable account. Wouldn't apply if it's in a Roth or an IRA. Whereas in the ETF's case, because the mechanism of forming and dissolving these units of the exchange traded fund, it differs substantially, then that other behavior, the other investor's choice to sell that ETF doesn't produce for you that tax consequence.
Yeah, that is definitely going back to the point Adrian made of tax efficiency. Uh, let's go on to the next topic, next frequently asked question. Uh, Eric, I'll let you take this one next.
Mm-hmm. All right. Well, I've got a couple more, but maybe this is the one that I think has been is a passion of mine, and it has to do with this. Here we're 3/4 of the way through 2022. We are near the lows of the year for 2022. In general, if you're thinking about what should I or should I not do any sort of Roth conversion in 2022, boy, oh boy, have you been handed a gift to be able to do that potentially at the lowest moment of the year. If you do that now, it is what you might be saying, Erik, what are you talking about? Why is it advantageous to think about a Roth conversion when markets are lower? The reason is that let's think about this as a share of stock XYZ. All you own in your portfolio is one and only one investment. It's XYZ. By the way, this is purely hypothetical. That would be utter folly to do so, but let's just use that as an example. XYZ, let's say at the start of the year you had 10,000 shares and they were each worth $100, meaning you had $1 million portfolio of XYZ. Now let's say XYZ has come down 25%. You still have 1,000 shares of it, but instead of 10,000 shares of it, I mean to say, but instead of it being $100 a share, it's now $80 a share. Well, what if you then went ahead and sold? Let's say you will say that instead of converting 800,000 that's in your portfolio still, you're going to convert, just as an example, this is purely for math purposes, you're going to convert 1/10 of your portfolio from an IRA to a Roth IRA. So here, since you have 10,000 shares of it, you sell on the basis of we're talking about 1/10 of the portfolio. You sell 1,000 shares of it at $80 a share. You just generated $80,000 of sales. You take the proceeds of that sale, convert them over to a Roth, and go in your Roth IRA now buy back those same 1,000 shares of XYZ at $80 a share. It costs you $80,000. Well, had you done the same thing at the beginning of the year when it was $100 a share to convert 10% of your portfolio, it would have cost you would have had to sell $100,000, move $100,000 from your IRA to your Roth to achieve that result. Remember that you might be saying, Erik, I still don't get it. Why is that advantageous? It's because here's the critical piece in this explanation. It's because the $100,000 that you would have converted at the start of the year, you would have paid taxes, income taxes on that full $100,000. Whereas if you did that at the market low when it's 20% down, you're now paying taxes on only $80,000 of that conversion. You just cut your tax bill for that conversion by at least 20%. So now you might be saying, well, yeah, but I only put $80,000 into the Roth, not 100. Yes, you did. That's true. But you put in the same 1,000 shares into your Roth that you would have done at the beginning of the year. You still have 1,000 shares of XYZ as the final result in your Roth now, but it only cost you $80,000 of taxes on $80,000, not taxes on $100,000 to accomplish that result. And when the markets come back, and I'll use when, not if, when the markets come back, then you'll enjoy all of that recovery for that 1,000 shares in your Roth, not in your IRA. So if you've said, Erik, that's still really hard to follow, I'm sorry. Find our contact information on our show page. That's retirementlifestyleshow.com, and reach out to one of us, and we'll go ahead and walk you through that explanation and think about it more instead of such a hypothetical case like XYZ is the entirety of your portfolio. We can help you in a little bit longer format, evaluate that, and see why doing Roth conversions when markets are down is absolutely the best time from a tax standpoint to do that.
Yeah, and just to highlight one thing that you said, Erik, when that XYZ recovers in your Roth, that's tax free,
Mm-hmm.
right? So you're paying the tax after the 20% loss in this example, and then you're getting that recovery in that tax free bucket, similar to what Adrian had said earlier about the different tax buckets that are out there.
Yes, and I'm going to highlight one more piece of this. Why am I just sort of pressing on you to think about doing a Roth conversion this year? We also are under favorable tax rates introduced in the 2017 Tax Cuts and Jobs Act that prevail this year. They've been in place since 2018, but we have only 4 calendar years left, this one included. So if you're talking about calendar year conversions, it may be to your advantage to get more of those accomplished in 2022, 3, 4, and 5 than afterward.
Yep. You want to make sure you get it at these lower tax rates. So in your example, you're doing the conversion at a lower value after the market declines, at a lower tax rate because the rates are going to go up in just a few years, and then that recovery would then be on the tax-free side of
Mm-hmm.
it. So it looks like there is definitely, at the very least, an opportunity worth exploring.
Mm-hmm.
Gentlemen, I know we've got a couple more. We are running a little bit short on time. Adrian, do you want to go over yours quickly, or should we go, Eric? I know you had one that will be fairly involved as well.
Yeah, we can move on to Eric. I covered all my frequently asked
Okay, I'll
questions.
make mine
Okay.
short. So I have a lot of clients that have been getting letters from their long-term care insurance companies lately. This is 5 years, 10 years, and sometimes longer into their policy saying, guys, we're so sorry, but not a lot of your peers are lapsing their policies and the costs have been running so high. Once upon a time, we thought we could deliver these benefits to you with premiums at such and such a rate that you've been paying, but it's just not working for us. So we had to go to your state insurance commissioner and just explain our situation. And your state insurance commissioner has agreed to allow us to go ahead and elevate these premiums a little bit. So we're going to have to do that here. And we're going to, because it's not a trivial amount, we're going to implement this over a 3-year period, but it's going to be, X number of dollars or X percent higher per month that you're going to wind up paying for these same benefits. Now, if you're thinking, oh my goodness, I don't want to, that's such a high premium cost, I'm not sure I want to do that. If you want to, so the letter says, you could go ahead and do some give backs on the benefits that you've been giving. So for example, you've been promised, for example, you could shorten the number of years or months that the benefits would pay out, or you could reduce the inflation component, the inflation adjusting component, or eliminate it altogether, or you could reduce the monthly benefit that we would pay out to you, blah, 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 or some combination of these things. And so these clients are saying, Eric, I'm just really thinking I'm going to be squeezed by these amounts. It just seems so outrageously high. Should I do this? My answer, of course, there's not a one size fits all answer on this, but it is this, that you have to think about the fact that the question that you're addressing now is not, would I have paid these premiums way back when I started this policy 10 years ago or 5 years ago, or whatever the case might be. The question is, if I walked into the long-term care insurance store today and they told me that I would get the benefits that are currently promised to me if I started a policy today and at the rates that they're offering me, would I do it? And I would say, insofar as in that 10-year period, you've aged 10 years. You're 10 years closer to that date at which you're likely to do it. You're likely to need that care. Or said differently, you have 10 fewer years of paying money out than you did when you began the policy 10 years before. The math is different now. While that might not have been a great decision to pay that premium load 10 years before, it could be an awesome decision to pay it today. So let me give you one just quick example. One of my clients and I were having this conversation on Saturday morning, and we talked it through, and what it worked out was that in this client's case, the effective cost was that if the client was willing to pay an extra $700 per year for this policy, they would receive the benefit of it. But in this case, this client's case now, given how much time has passed since this client obtained that policy, if we use age 80 as a common age of inception, this client has 6 more years to pay. 6 more years to pay $700 a year. By the way, this is not a prediction that this client's going to need this care starting precisely at age 80. It's just using sort of the logic of this. If that's a characteristic age at which the inception of benefit often begins, then if 6 more years paying $700 a year, let's just do the math on that. 6 times 7 is $4,200. $4,200 in this case preserves what, if she wants to keep her benefit, or pardon me, keep her premium level at it is, she would cough up about 25% of the benefit in her policy, meaning she would cough up $70,000 worth of a pool of benefits. I would say, and as I said to this client, I won't use her name, I'm just going to make up a name, Jane, if you could put 4,000 to, you walked into the long-term care insurance store today and they offered you to pay them, you could pay them $4,200 in exchange for a pool of long-term care benefits that was $70,000 large 6 years from now. Would you think that was a good trade? Swapping $4,200 of your money for $70,000 of their benefit pool in 6 years? I think you would. Oh, well, you might say, well, wait a second, Eric, I'm not sure I'll need it. Okay, let's say that there's only a 10% chance that you might need that benefit. In other words, let's say it differently, that instead of it being 70,000 that's waiting for you 6 years from now, it's only 7,000. Would you still trade $4,200 over these next 6 years for that $7,000 benefit? I think you probably would. So in other words, it's not a question of what should she have done for 16 years or 20 years. It's what does she do for this last 6-year period? The benefit cost ratio has really substantially shifted in her favor because she's so much later into this policy. So again, if you're going, Eric, that was so confusing. Well, that means I'm not a great communicator. But it also might mean that the topic warrants that you go ahead, go to our website, find retirementlifestyleshow.com, find our contact information, and say, reach out to us and say, would you explain this to me? Because I got that same letter and I'm trying to decide what to do. And we will help you make that analysis.
Yeah, and I think the concept though is, what's your cost versus what's your benefit going to be, your possibility of benefit. I think that holds true to everybody. And as we mentioned earlier, uh, as a topic that I was getting of people about looking at their plan, I think you can't make that decision in a vacuum. You've got to
Right.
look at everything else going on in your personal financial situation. So it is a complicated one, which doesn't make it easy to just describe on a podcast, or even if you're watching on YouTube right now. Gentlemen, that's a lot of questions we've all been getting today, and I'm sure we will have more. So we'll do another episode like this. For those of you listening, please send us your questions. They will likely make it into an episode in the future. Thank you again for joining us and listening. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family about us, and we'll be back next week with another great episode.